Okay, so I think we can get started now. It's 11 o'clock, so I just want to welcome everyone. So listeners are on mute, and this webinar is being recorded, and we will send out copies afterwards. So first of all, good morning, everyone, and welcome to the Ortencio Group's third quarter webinar. As always, I have with me Gareth Watson, Director of our Investment Management Group at Richardson GMP. Since our last presentation, there's been several catalysts to the volatility in the markets, and right from the beginning of the year, we have said that volatility was going to come back in 2015, and it has. And lately, some of the headline news that have provided fuel to this volatility has been China and their economy, along with the People's Bank of China's decision to devalue currency. What's in question is the accuracy of the growth rate that they've stated. That's been in question. The price of oil has bounced around at record movements, going from sub 40 and then up to over $50. Goldman Sachs has lowered their prices to, I believe it's $20. And of course, one of the more long-awaited U.S. Fed meeting on interest rates last week, and the decision to hold off on interest rates and keeping them at record lows of 0 to 25 basis points. Many were hoping that the Feds would finally start raising the rate, but that didn't happen. And in the week prior to that, the Bank of Canada decided to keep the rates at 0.5%. Some anticipated that they may lower the rates by a quarter point. So for the first time in a while, the view of the two U.S. Federal Reserve Board and the Bank of Canada, they usually move in unison. I think for the first time in a while, they may move in opposite direction. And then throw in the GDP numbers that came out of the last quarter showing that Canada experienced contraction, hence putting the country in a technical recession. Now, the final component is an election and possibly a new government or maybe even a minority government. So there is definitely many catalysts to provide fuel for the volatility flame. So with all those issues, you'd think we'd stock up on bottled water and canned goods. Our view is to hold off stockpiling on that. And, what we've seen is a healthy correction in the U.S. market, where we have not seen something like this since 2011. So a correction is defined by a 10% decline from their highs. So this has been long awaited, and that's why we're very surprised when it has happened. People are surprised. So before I turn it over to Gareth, I wanted to recap a couple of numbers. Year to date, this is as of September 18th. So you'll see in this slide that the TSX Composite Index year to date is actually down about 5.78%. The S&P 500, which is the U.S. broad-based market, is down 3.3%, but in Canadian dollar terms, it's actually up 9.7%. So you can see what's happening with the strength of the U.S. dollar versus the Canadian dollar, what that does for Canadian investors if they didn't hedge their currency. The MSCI EAFE, which is Europe, Australasia, Far East Index, is down 2.42%. Again, in Canadian dollar terms, it's 10.81%. And the emerging markets is down 13.47%. The DEX bond is up 2.4%, and then as we talked about oil, it's resting at about 46.90, which is down 12%. And our Canadian dollar to U.S. is at about $1.30. And then the 10-year government bond rates are at about 1.5%. 12 months ago, it was at 2.28. So we've seen a decline in bond rates and also in the U.S. Treasury. So you can see that there's most of the global markets, including and in Canada, are negative, but what's providing a little bit of strength for the Canadian portfolios is the weakness in our dollar, hence the benefits of diversification within our portfolio. So, with that in mind, I want to pass it over to Gareth and give you a little bit more of a detailed understanding of what's happening out there. So, Gareth, I'll pass it over to you.
Great. Thank you, Frank, and thank you to everyone for joining us today. I'm going to take probably about 20 minutes of your time to go over a few things here today about the global market, touching on what's happening in the United States, Canada, and Europe, and a little bit on China. Just first of all, revisiting some themes from our last call. These are some themes that we had at the very beginning of the year, so I always like to touch back on what we were saying at the beginning of the year. And for the most part, our predictions are holding true. The global divergence, and what we mean by that, of course, is just differing monetary policies, as the Americans are tending to look to raise rates while most other central banks around the world are likely still either cutting or going to be keeping them low for a considerable period of time. That continues. The only snag that we've had recently was at one point there was an expectation that rates were going to move higher last week in September. That has been delayed due to some recent volatility in the marketplace that has the Fed concerned for the time being. The expectation, though, is that those rates will eventually go higher. Still not a lot of debate as to when that's going to happen. There is currently probably more weight put on December right now than October. But long story short is we can debate the date, but at the end of the day, higher rates are coming to the United States. And just to touch on the market uneasiness in China, there was a lot of reasons given out there, especially when we had those material declines a few weeks ago, as to what the catalyst was. In terms of one specific real reason, I think it was a number of reasons put together, and China was most of the concern. But I think what the market was saying here was that they just didn't like the type of interference they've been seeing from the Chinese government on both the market side, trying to manipulate their equity markets, which they did a terrible job at and really screwed that up. And then the currency, we can call it a devaluation. 3% is not a devaluation, really. It is lowering the currency. But when we talk about devaluations, usually we're talking about much larger numbers than 3%. But it just wasn't handled very well by the Chinese. It wasn't communicated very well by the Chinese. And when that happens, markets get a little stingy and they tend to sell off. I'm just going to talk on volatility. We knew that it had been dormant for such a long time that it was almost due to return, and it has come in spades. Admittedly, we're not at the levels of volatility that we saw a few weeks ago. It's starting to come back down to more normal levels at this stage. The United States dollar continues to remain strong and will likely continue to remain strong for some time. The Canadian dollar, unfortunately, is going to not benefit from that at all. The days of the cross-border shopping trips, I think, have come to an end. Although you can still get really cheap stuff in the States, let's face it, no matter what you're paying on the currency. Inflation is going to be more topical going forward, particularly in the United States, as it was one of the reasons I think that the Fed leaned on as to why they didn't raise rates. They do have a strong economy, employment is strong, but one of the factors that they do consider in interest rate policy is inflation. And I'll show you later in this presentation that there isn't a heck of a lot of it in the United States. So to a degree, you could say that the Fed was justified holding off for now. And of course, here topical in Canada, the outlook for oil prices. Since the last time that I spoke with you, we have become even more, or I should say the market has become even more bearish on oil prices as we've tumbled down into the 40s level, and I'll address that momentarily. So just a couple of quick notes here on monetary policy. Interest rate policy is what I'm talking about. Just a brief overview of what's going on around the world. The United States, I jokingly say, get on with it already. We are so sick and tired of talking about this on Bay Street as to when the Fed will move, and what we really want to know is not when they move, but how quickly they'll move and how many more rate hikes will be coming after the fact. It looks as though the increases will be slow and gradual, certainly as a result of the most recent meeting with them deferring until later to start raising those rates. The United Kingdom, we had expected no change this year, and there probably will be no change this year, but they are also another country or another central bank that will likely be raising rates sooner than cutting. They are now in a position where they believe that they can likely move rates higher. So unfortunately, if you are going to the UK, first of all, you know that the pound has been strong recently. It's probably going to get stronger, unfortunately, because interest rate increases are very much likely to come in 2016 for the UK, and that is not the cards for Canada. Japan, I don't know if Japan will ever change their interest rates ever again at the rate they're going, so we're not expecting any change there. Same with Europe. That's because, of course, they have just introduced in the past year their big quantitative easing package, and they're in no position at this stage to raise rates anytime soon. And Canada, of course, at the beginning of the year, we were a little caught off guard by the first interest rate cut. Then everyone jumped on the bandwagon of cutting more, which they did, but I think we're done. I think we are not going to see any further interest rates coming in Canada unless the economy materially declines. The Bank of Canada, I think, is concerned because they're not seeing investment on the fiscal side from the government. So in this period of weakness, I think they have felt the need to act to counter that weakness. And if we're not going to do it through fiscal policy, then unfortunately we have to go through monetary policy, but we don't have a heck of a lot of levers left to use. So that's why you've seen the cuts this year, even though I'm not particularly sure how effective they've been. On the United States, I will mention that growth is still there. It's not going to be the type of accelerating growth we've seen over the past couple of years, but I do think it's stable. And that's pretty key here. Employment has a lot to do with that. Americans are getting jobs again. They are spending money again. Their debt levels are lower. They're dealing with lower oil prices, so they have cost savings there. There's a lot of things working in favor for the U.S. consumer, and that's showing up in the growth numbers. On the corporate side, there are a few headwinds coming, or they have already come, actually, I should say, in the form of a stronger U.S. dollar. If you're a multinational firm and you do business elsewhere in the world and the U.S. dollar is strong, when you're repatriating profits from other countries, they come in obviously lower than they would before because of the currency effects. So it is a lot tougher for some of these big multinationals to grow their revenues internationally and to grow their profitability internationally because of currency headwinds, and those are going to hang around for a while. So we're not putting up a red flag saying that corporate earnings are atrocious and they're horrible and everyone should get out of stock, but there are definitely some obstacles that exist today that didn't exist 1 year ago that corporations have to deal with, and admittedly, it's currency related. It's not operational related, which is a good thing. If we had problems with operations, we'd be having a different conversation, but these accounting issues do come into play when it comes to revenue and earnings growth.
And a possible increase of interest rates is going to put more, I guess, pressure on the upside for the U.S. currency to go up again.
Correct, and yeah, I mean, I would say that the market is pretty good at pricing in expectations. So if you were to say to me, is the U.S. dollar going to rally a lot when they finally do raise rates? The answer is no, because the market's already expecting those rate increases. Okay. The way that you get more strength in the U.S. dollar is if down the road the Fed ends up raising rates sooner and by a larger magnitude than previously expected. Then you could see some more strength. And the other problem here too, with higher interest rates, for corporations, they've been dealing with extremely low borrowing rates for an extremely long time, and of course, those borrowing costs are now going to go up, which means interest costs are going to go up. So there are going to be further headwinds to come for corporations to deal with because of the rising interest rate environment. But don't get me wrong here. Rising rates is a good thing because that means the economy is doing well. We don't want these low rates forever because that's just a sign that the global economy is just not accelerating at all. So it's time we get beyond this zero interest rate policy and move on back to what I would like to consider, let's call it normal economics, which we haven't seen for some time.
And is that why we're seeing more volatility? And it was the market expecting a rate increase, and if they got it, would we see more stability in the market? Always hard to predict, but I actually would say yes. I think that because they telegraphed it for September initially, they did kind of change their tune a bit leading into the meeting. But when they telegraph things and they actually carry them out, the market doesn't really, do anything severe in terms of reaction. It's when you think something's going to happen and then the opposite happens that the markets take a fit. And the volatility increases. So a lot of people say, well, higher rates are not necessarily good, so wouldn't the market have sold off? I think the market has been expecting this for so long that if we finally got that rate increase, they'd almost be happy, quite frankly, because now we'd actually be on track and following what the Fed had led us to believe in the first place. So I just want to touch on the inflation here because it is going to be topical. It was mentioned in the last Fed release. As you can see, there's two lines here. It's very easy. The overall inflation rate is the blue line. As you can see, it has tumbled down to just north of 0%. The reason why it's fallen so much is simply because of oil prices. I think most of you can understand how going from 100 plus oil to 45 or wherever we are today, you cut that in half,
you're going to see downward pressure on prices overall, gasoline in particular, of course, at the pumps. And that's why that line has fallen as much as it has. Now, when we look at inflation, a lot of times we also like to look at what we call core inflation. That's when we back out food and energy prices, which tend to be a little bit more volatile. And when we take those out, you get the orange line. And that line has been below 2% for a long time. And the average rate that I think central banks feel comfortable with for inflation is 2%. So some of you might be saying, well, isn't that basically good enough what we're seeing right now? But as you can see, there's been no acceleration in inflation. There's been no upward pressure on inflation. And central banks tend to raise rates when inflation starts to accelerate. And so if you don't have inflation accelerating, it becomes a little more tougher to justify moving interest rate policy higher. And I think that the Fed kind of fell back on that as a good excuse just to hold off, not just because of the inflation story, but because of what else is going on in the world and in other markets. Now, with respect to Europe, I'm going to be very brief on this one because not a heck of a lot's actually changed since I talked to you last. Monetary policy, obviously, the quantitative easing is going to be around for a while. We are seeing some improved statistics out of a number of European countries, not to say that they're in the clear at all, but things are improving. The finance costs remain low. Obviously, they're being helped by a relatively weaker euro compared to the U.S. dollar, trying to pick up business there. China's their biggest customer, so that's a good thing for them in terms of at least having a weaker currency, not necessarily any type of slowdown in China. That's not good for them. But the weaker currency certainly helps powerhouses like Germany. Germany is benefiting from the fact that a lot of periphery countries have not done well for a long time because they get the benefit of the weaker currency overall within that eurozone. And energy costs are lower. This is huge for Europe. A lot of countries do have to import their energy, and this is why we've seen a huge geopolitical shift in power and control from even just I'd say a year and a half ago, where Russia was exerting huge amounts of influence over European countries about natural gas and pipelines going from Russia into Europe, and their control over energy costs in general. And a lot of that power has now disappeared as pricing for both oil and gas has fallen. So we've seen a huge transition happen there in Europe, and it's obviously to the Eurozone's benefit. I do want to touch on Canada, obviously. We are finally seeing signs of the oil price decline fallout in the broader economy, as we are, as Frank mentioned, in a technical recession. I would say the jobs data that we saw on the last monthly report and some other data since would suggest that we will likely return to growth in the third quarter. So, and that's also because actually the last month of the second quarter, the June quarter, we actually did see GDP growth. So we were growing in June, we weren't growing from January to May. So the trajectory right now is for a better economy if they can keep that up going into July. But nevertheless, the economy did go through a rough spot in the first half of the year. A good chunk of it can be attributed to the energy sector. And so that continued weakness could continue to be a drag on year-over-year comparisons here going forward. With respect to rate hikes, definitely not in the cards this year. I do not believe they're in the cards next year unless things improve considerably in a very fast period of time, which I don't necessarily foresee. So in terms of interest rate policy and people wondering when are rates going higher, I still think we've got a ton of time on our hands here. So those variable borrowing rates out there, whether it's a mortgage or line of credit, people are going to be given a reprieve. But let's be blunt here. Once those rates do go higher, there's going to be a lot of hurting Canadians in this country because there are way too many people that are over-levered and have too much consumer debt. I actually have to renew my mortgage in October. I went in on the weekend to check in on rates at the bank and discovered that, yes, I'm going to have to start paying more next month for my mortgage, and I'm on a variable rate. And it's not that much of an increase. Let's remember here, just because if your interest rate goes up 100 basis points or 1%, doesn't mean your mortgage payments go up 1%. That's unfortunately something that a lot of people believe, and they get caught off guard when they find out that their mortgages actually go up by a heck of a lot more than 1% with a 100 basis point increase in mortgage rates. So this is going to be an issue in this country going forward of people that can afford debt at today's rates, but they can't afford it, let's say at rates 2 to 3 years from now. Now, with respect to the election, the fiscal management of this country, I can't tell you whether we will balance the budget this year or not. The Conservatives will tell you we will. The opponents say that the surplus of the first couple of months is misleading, and that in the end it will be a deficit. I think the arguments are relevant. Whether we miss the balanced budget by $1 billion or $2 billion is irrelevant in the bigger picture of things. What's really important is what's going on in the Canadian economy, and if it is not doing well, what are we doing to support it? Where are we making investment? Where are we supporting the economy where industry no longer is? Because billions of dollars are now not being spent in the oil patch on capital expenditures that were being spent before. That is a huge amount of money that is not being invested in the economy. There are people losing their jobs in the oil patch, so you're seeing royalty revenue go down, you're seeing income tax revenue go down. These are serious issues which do require some action on the federal level in terms of investment, and that's why we're seeing a lot of posturing here amongst the parties within the election as to how that investment is going to come. And of course, there's a balance. Obviously, we love investment, but it has to be done in a fiscally responsible way. And that's where, and I'll be very politically neutral here, you as voters have to make your decision as to who provides the right plan going forward. Now, are we ready for a change in government? Are the markets ready for a change in government? Well, I'll just say this. Markets are never ready for a change in government. It doesn't matter who you are, what country, what party. A change means something different that's unpredictable, and you don't know exactly what's going to happen. So the markets don't necessarily like that. There is some short-term volatility. It usually doesn't last very long until the party that wins comes in and you realize it's not going to be a disaster after all. Or if it is going to be a disaster, then yes, the markets will react. We tend not to see the reaction in equity markets as much. We do tend to see it more in currency markets. So, for example, if the Liberals or the New Democrats form government and the market just doesn't like what they're going to do economically speaking, then you could easily see the Canadian dollar sell off after the election. Again, it might be short-lived. It might be more permanent depending on what policies get put in place. But I will just make the general comment that markets in general do not like change. It's not to say that it's a bad thing. It's just you're upsetting the wheel cart that or as people like to say, dance with the devil you know as opposed to the devil you don't know. That's what elections do when you bring in a new party. You just don't know exactly what's going to happen. Again, it could be just fine, but that initial reaction or that initial gut reaction or tweak reaction is to put downward pressure on the currency. In terms of the equity markets, the only exposure or the only reaction that I could see from what I've seen so far is the NDP plan to raise corporate tax rates from 15 to 17%. There's a lot of debate as to how impactful that is to the economy. That would be one of those initial knee-jerk reactions where you could see stock markets sell off, but briefly. I think they would recover. I think it would be short-lived. So again, I think your greater reaction to the election is going to be in the currency market as opposed to the stock market.
So simple terms, uncertainty is, the market does not like uncertainty.
Oh, no, it never likes uncertainty. I mean, there are some policies that could come into place that could affect the Canadian market. I shouldn't say it's just about the corporate tax rates. I mean, there could be some environmental policies put in place that could easily impact the oil and gas sector further than they've already been impacted. So there are some industry-specific legislation that could come into play that could hurt or help, for that matter, certain industries. But it is industry-specific. It's not a broader market issue like the corporate tax rate changes would be.
Okay.
And just a couple last comments here on markets. It has been an absolutely atrocious year for commodity prices, and most of you are aware of the fact that the TSX index is down on the year. It will very likely finish down on the year unless we have a significant improvement in market sentiment, which I don't foresee coming in the next 3.5 months. This is one of the reasons why the market is down. It's really hard to have commodity prices go down and have the TSX go up when you have 40% or so of the market weighted towards oil and gas and materials together. In particular, obviously oil, very sensitive. It has not been a good year for oil, which is the WTI crude prices here. They're down 16% year to date. but the base metals are not doing well. The agricultural commodities, in fact, the only, I was looking at a list of commodities yesterday on year-to-date returns. The only one that I could find that was up, and this is like a whole bunch of commodities, was cocoa. If you've been investing in cocoa, you're doing just fine. If you've been investing in anything else commodity-wise, you have not done well. And this is including things like coffee and concentrated orange juice and all kinds of stuff. Cocoa was the only one that survived. So as a result, you get this, which is a sell-off from the beginning of the year in the TSX exchange. We have had our financials have actually held up reasonably well, considering a lot of the headwinds that the market is throwing at them with respect to the oil patch, or lending in the oil and gas sector, which is actually fairly small, about 2 to 3% of loan books, if not smaller, amongst the banks. Some concerns about mortgages in Alberta, even though I don't think we've seen a huge sell-off in real estate prices just yet. And of course, just consumer debt issues overall, and the fact that Canadian growth has been sluggish of late. Still, Canadian banks continue to make a heck of a lot of money. Had a, I'd say, very good quarter relative to expectations last time out. And so they're holding up reasonably well, but that downward pressure there is certainly mostly resource related. And unfortunately, we don't necessarily see a big turnaround between now and the end of the year in the resource space. And so unfortunately, this weakness will likely persist. And finally, on the Canadian dollar, whole bunch of reasons as to why this is going in the wrong direction. It was initially a story of U.S. strength as opposed to Canadian weakness. The U.S. dollar, which had been beaten up for years, finally caught a bid and rose higher, especially once the European central banks introduced their quantitative easing. It really put downward pressure on a lot of other currencies, and people just fled back to the U.S. dollar for safety. Also, the U.S. economy doing very well is the reason why that has strengthened. The Canadian dollar then, of course, continued to fall as we got into mid-2014. That's when the oil price, if I can call it, collapse happened. You can see that big leg down from July 2014 down to January 2015, most of that oil-related. And then this recent weakness here, July onwards, I think has just been more a fact of Canadian economic growth underperformance. So there's all kinds of factors feeding in here, and also the rate cuts that happened in this country. They definitely did not help either. And it is really hard to find a reason to get excited about the Canadian dollar right now. So could we go lower? Yes. And again, I think this will be dependent on what the Fed does and how aggressively they do it. Could you get down to 70 cents? Maybe not this year, but in the next 6 months, possibly, if those conditions do prevail. And also, again, the election will have some type of impact here on the currency come October the 19th. But in terms of a return, let's say, up into the 80s, it's really hard to find a situation in the next year that would occur in Canada that would allow that to happen. So I think Canadians need to just have an expectation that the loonie is probably going to stay where it is, or potentially dip a little bit lower here between now and the end of the year. And going forward over the course of the next year, especially with what we might see from the Federal Reserve, it's pretty tough for us to get back up above that 80-cent level going forward. So again, if you were doing the Black Friday trips down to Buffalo or anywhere in the United States for the outlet mall shopping this year, probably going to find it a little bit more expensive, unfortunately, and I'm not sure how cost beneficial it will be. Although, again, Americans are really good at selling stuff for nothing, so you can still probably get some bargains. With that, I'm going to finish my remarks there, and I will pass it back to Frank. I don't know if you have any other questions, but happy to answer them if you do.
Yeah, no, that's great. I did, but you've covered most of it. So I just want to thank Gareth again for joining us, taking the time to give us your insights into where we were and where we think we're going. And I think the important part to remember for our listeners is that, even though we're not so bullish on the Canadian side, the best part about how we manage portfolios is about that diversification strategy and being able to invest not just in Canada but everywhere else around the world in different asset classes. And at the end of the day, I just want to reiterate the philosophy of our team and our approach to diversification and disciplined investment have again proven to be the key to the success of your portfolio. So with that being said, I want to thank everyone for listening in, and thank you for your trust with your Ortencio Group, and we want to ensure that you know that we do not take that trust lightly. So thanks everyone for listening, and we'll see you soon.